Alexander Deviants present The Eye-Popping World of Financial Accounting, Part 1.
And welcome to the eye-popping world of financial accounting, Part 1. Over the next 2 hours, we'll do our best to supplement and enhance your learning of the basics of accounting, including financial statements, double-entry accounting, the general journal, and much, much more. As always, we're here to help you learn, but we're also here to keep you awake with our exciting minds and our downhill swivel chair races.
Don't forget, this is a video, so you can pause the tape, stop the tape, or rewind the tape at any time you like. If you need to see something again, just rewind the tape and watch us again.
Now it's disclaimer time. You must remember that this video is intended to supplement a basic accounting course. It's not a substitute for attending class. To truly learn accounting, you must attend your classes, read your books, do the homework, and listen to your professors. So, go to class.
Without further ado, I now present to you the eye-popping world of financial accounting, Part 1.
Part 1, the basics of accounting.
Section A, the accounting profession.
Let's start with the accountant, the heart and soul of accounting.
Today, class, I found an accountant to share with you. Can you say accountant?
Accountant!
Very good.
What's an accountant?
Well, a long-standing definition for accounting states that it's the art of recording, classifying, and summarizing in a significant manner, and in terms of money, events and transactions which are at least partly of a financial nature, and interpreting the results thereof.
Why don't accountants wear pants?
The accountant's job is to look at a business's transactions, decide how to record those transactions, and compile financial statements to report on the status of the business and the business's money.
Accountants work in many areas, primarily in public accounting and in industry, also known as accounting for businesses.
A public accountant provides services to businesses on things like tax advice and preparation, audits, and advising on management practices.
Another type of accountant is the accountant for industry. They do the books for a business. These accountants will be the focus of our discussion during this course.
Accountants for industry will understand the often ambiguous and confusing characteristics of the internal financial workings of a business.
Section B, accounting principles and guidelines.
Accountants classify financial transactions by putting the numbers into accounts. Accountants must classify a company's financial events for that company. If there weren't a set of guidelines for accountants to classify financial information and transactions, everyone would have their own different setups, and there would be no standard way to classify this huge amount of information, and complete chaos would ensue.
Accountants Accountants must work under a series of rules and guidelines that help them make basic decisions. These guidelines are known as Generally Accepted Accounting Principles, or GAAP.
GAAP is based on a number of accounting concepts and assumptions.
The business entity concept states that businesses are treated separately from other businesses and individual people. Businesses are separate entities from the owners for accounting purposes. Therefore, the assets and liabilities of the business are kept separate from the assets and liabilities of all others, including the owners and creditors of the business.
For example, let's say the owner's a big fan of remote-controlled trucks. She plays every day at lunchtime. The accountant will not count her trucks as company property, even though they're on company property, because they are an asset of the owner. So the bankers cannot use the toy trucks.
The cost principle states that the assets must be recorded in a company's accounts for the cost at which they were originally purchased, not at a perceived market value.
But there's nothing that says that I can't jack up my prices and rip you off. What time's karaoke start at the bar?
An example of the cost principle is our producer, Chris Mattingly. When we first hired him 6 weeks ago, his market value was 4 times what it is today. So even though the company may feel that he's actually worth much less than he cost on the books, we record the amount we originally paid for him.
We can earn revenue whenever we sell a pair of jeans to a customer. The matching principle states that we need to record all the expenses we incurred while selling these clothes, like my salary, in the same time period we record the sale.
GAAP has other principles, but we focused on 3 of the most important. So remember, the 3 principles we discussed are
1. The business entity concept. 2. The cost principle. And 3. The matching principle.
Now let's briefly discuss types of business organizations. Then we're going to talk about my briefs. They're very comfortable.
Section C, Business Organizations.
The 3 types of business organizations are the sole proprietorship, the partnership, and the corporation. Of course, we should mention that each type of organization has different advantages and disadvantages, especially when you consider taxes and liability.
We'll talk about the sole proprietorship first. A sole proprietorship is a business owned and controlled by a single individual.
The advantage of this formation is that the business is considered personal and is therefore taxed at personal income rates, as opposed to other more costly levels. There is no separate income tax on the sole proprietorship, which is a big advantage. The main disadvantage of the sole proprietorship is that legally, the owner is personally liable for all debts of the business. So although the business assets are separate from the owner's personal assets on the books, in the event that the business defaults on a loan or is sued by someone and loses, the owner's personal assets can be seized.
Thank you.
Elroy, tell our friends at home what a second type of business is. It's a partnership.
Partnership.
That's right. You and I are partners.
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 Like, oh, because we have the tree farm.
Right. We have a tree farm, so we're partners.
Partners.
A partnership, though, is different than a sole proprietorship because in a partnership, it can be owned by more than one person.
Like you and me.
Right, like you and me.
We're more than one.
Well, okay, as I was saying, in a partnership, each individual person acts as a sole agent in the partnership and is liable. Responsible for the debt incurred by the partnership.
Liable.
The third and final type of business organization is the corporation. The corporation is considered a separate legal entity from its owners and managers and frequently exists for the sole purpose of conducting business.
The major advantage to the corporation is that the owner's personal stuff is not liable to the legal claims against the corporation. The owners of the corporation are the shareholders, or those who purchase pieces of the business in the form of stock. Corporate income may be distributed periodically to the owners or the shareholders in the form of dividends.
The most a stockholder can lose is their original investment in the stock of the corporation. So a huge advantage of the corporation is no personal liability for the owners.
Mom?
Timmy, I'm your dad.
Oh, Dad.
Jerry took 15 of my marbles because he said the corporation before went bankrupt, so he took them.
Well, if you and your brother formed a corporation, then he can't seize your personal properties.
Well, what if he doesn't give them back?
Oh, Timmy, you're just going to have to fight your own financial battles.
Wow, you're right, Mom. Dad?
A big succo disadvantage of a corporation is that corporate income is taxed twice. First, the business's revenue is taxed at the corporate rate, and then the owner's dividends are taxed at the personal income rate.
For the purpose of this video, in studying basic accounting mechanics, our focus will be on the sole proprietorship. Using the sole proprietorship will keep things clearer as we move along. Hey, what's with the mink oil?
Section D, Accounts.
Now we move on to the building block of accounting, the account.
When a transaction occurs, the accountant must accurately record it. The record or dollar amount is placed in an account. Accounts are grouped in what is often called the books.
The books are where the business's accounts or financial information is stored. Thanks. The standard definition of an account is a labeling of similar records for the purpose of classification and accumulation. So, the books are a place where similar transactions are grouped and recorded. Look, I've even got a book already.
Dollars spent on the same type of things are placed in the same account. The accountant must record business transactions and money for the business and records those transactions or funds in different accounts based on their types. Nickel? Thank you. The accountant creates accounts for the purpose of storing already classified information.
Oh, hey, how y'all doing? Now, you see how I keep all my tools together here? Well, accountants do the same thing. The accountant examines the transaction, figures out what type it is, then stores or places it in the appropriate accounts in the books.
Section E, the 5 account types.
Accounts themselves are classified under one of 5 main account types: assets, liabilities, owner's equity, revenues, and expenses. These are like super accounts because every individual account on the books must be classified as one of these account types. The first account classification is the asset account. Assets are something a business owns. An asset is used directly or indirectly in the production of revenue. The value of that asset is placed in an account labeled for that asset.
Some examples of asset accounts are cash, which is the account that represents the dollar amount of actual cash available or on hand; accounts receivable, which is the account that represents money owed to the company by its customers or clients; supplies on hand, which is the account that represents the dollar amount paid for supplies on hand; prepaid expenses, the account that represents money paid on future expenses like rent or utilities; office equipment, or the account that represents the price paid for office equipment; and building, the account that represents the price paid for the office building itself.
The second account classification is called a liability account. A liability is a claim on the assets of the business by an outside party for money or services. Liabilities are something we owe.
The best way to think of a liability is as a bill. The liability account is a dollar representation of that bill. Liabilities, or bills, may be secured or collateralized by the assets of the business. This means that if the business doesn't pay its bills, the creditors can sue the business and force the sale of enough of the business's assets to pay them back. Yipes!
Liability is not to be confused with liability, which first-time job seekers often employ in interview situations.
So, why do you think you'd be good for this job?
Well, for a while there, I was the Prime Minister of West Virginia. And after that, well, I did a little work for Napoleon. I was his personal hairdresser.
Very impressive.
And before that, I did a little bit of work for the Ottoman Empire. And before that, see, I was in Egypt, and they were going to put these big cubes up. And I went, nah, pyramids. Pyramids are the thing, you know? Yeah.
Some examples of liability accounts are accounts payable. the account that represents the dollar amount of bills owed to others, and mortgage payable, the account that represents the mortgage or a loan on a building which is secured by the building. In other words, if you don't make the payments on the liability or loan, you lose the asset.
The third and by far most confusing account classification is owner's equity. Owner's equity is the term which stands for the owner's investment in the business and the capital a business has accumulated. As the business earns revenues, the owner's capital or owner's equity increases. As the business incurs expenses or registers a net loss, the capital or owner's equity decreases. Also, as the owner invests more of his or her own cash, the owner's equity increases.
Assets are everything that I own. Yay! Liabilities are everything that I owe. Boo. Owner's equity is the difference, or what is available for me to enjoy.
Owner's equity tallies the dollar amount of any actual changes in the owner's stake in the company. So, all owner's equity accounts accumulate a change in the owner's capital in the business.
In a sole proprietorship, the primary owner's equity account is the owner's capital account. In a sole proprietorship like we are studying, there is only one owner, so he or she owns it all. But in a corporation, there are many owners, so owner's capital is a reflection of all of the owner's capital. We'll discuss the corporation more in Tape 2 of Basic Accounting.
Good evening. I'm Sunny Day.
Hello once again, I'm Storm Window. Once again, we've just received a report that owner's equity equals the owner's stake in the assets, and that owner's equity tallies the dollar amount of any actual changes in the owner's stake in the company.
Remember that, everyone. After all, you'll be held accountable.
Did I miss something?
Owner's equity also includes the effects of the revenue and expense accounts. However, expenses are first subtracted from revenue to find the net income for the company. This net income total then affects owner's equity depending upon whether its total is positive or negative.
The revenue account totals the increase in a business's assets from the sale of its goods and services. Essentially, this account calculates the success of the company, so it reflects the success of the owners as well. I, as you can see, am very successful. This cigar was handmade in sweatshops in the Dominican Republic. You know what I'm saying, baby?
Expense accounts tabulate the drain on a company's finances for goods and services used. As a company's finances are drained, the owner's equity is lowered too. The dollar amount of all expenses, regardless of which particular type, are calculated here.
We know that these are difficult concepts, but they will become clearer as we move forward.
Section F, Financial Statements.
The end results of the accountant's work are financial statements. A financial statement is simply a piece of paper or computer screen containing some type of financial information. Accountants accumulate all of the data from the different accounts and place this data in financial statements so inquiring minds can analyze the financial condition of the business.
I want to know.
Good financial statements are absolutely essential to companies because they can help to evaluate the health of a business.
The most important financial statements are the income statement, the statement of changes in owner's equity, the balance sheet, and the statement of cash flows.
For the purposes of this tape, we will concentrate on these three financial statements: the income statement, the statement of changes in owner's equity, and the balance sheet.
The income statement looks at the profitability of the business for a specific period of time by subtracting expenses from revenues. This gives you the net income of the business.
So, the income statement lists a company's revenues and then deducts its expenses, which results in the net income of the business. Most businesses use monthly, quarterly, or yearly income statements. The statement of changes in owner's equity describes the changes in the owner's stake in the business, or the capital of the business over a specific period of time.
The first line of the statement is the owner's beginning equity, or the total capital or equity at the time the previous statement was prepared. Then the new investments made by the owner or owners into the business over the time period of the statement are added. The net income is then added because it is an increase in owner's equity. After this, any asset withdrawals the owner made for personal use are also deducted. The result is the owner's ending equity at the end of the period.
With these two statements completed, the balance sheet can now be constructed. This statement looks at the balances of all the asset, liability, and owner's equity accounts at a specific point in time, unlike the last two statements, which extend over a certain period of time, often a year. So once again, the balance sheet examines the balances of accounts at a concrete point in time.
So, Mr. Former Prime Minister, is it? What would you say your weaknesses are?
Well, I'm really hard-working, you know, so I tend to just shoot up that corporate ladder like a rocket, you know, right past the people who interviewed me, so pretty soon they're underneath me and I'm their boss. They get a little, they get a little jealous, a little envious, and they tend to be a little crazy about it, you know, they kind of hate me.
On the left side of the balance sheet, all the asset accounts and their balances are listed. These balances are added together to provide the total assets amount at that concrete point in time. On the right side, the liabilities and owner's equity accounts and their amounts are listed. Then, these are added together to show the total liabilities and equity at that concrete point in time.
When a company acquires assets, they will often incur liabilities or expenses. So, for that reason, one side, the left, shows the resources or assets of the company, and the other side, the right, shows the sources of those resources, or the liabilities and owner's equity of the company.
Section G, the accounting equation.
The balance sheet format helps to illustrate how assets, liabilities, and owner's equity relate to each other.
The left side of the balance sheet, assets, must equal the right side of the balance sheet, liabilities plus capital. That's why it's called a balance sheet. The underlying assumption behind balance sheet is the accounting equation. Let's now discuss this new building block of accounting, the basic accounting equation. This is the fundamental overreaching concept in all accounting transactions.
The basic accounting equation states that total assets must always equal total liabilities plus owner's equity. Why is this? The actual mechanics for the accounting process require that each side of the accounting equation equal or balance out to maintain accuracy.
Balance and accuracy are key.
After every transaction, the accounts must balance. Now, if this sounds like new information to you, well, it's not. Okay? Go back, rewind the tape, buddy.
So, every entry requires another entry be made to balance the books. That keeps the accounting equation in balance. Now, don't forget, the second entry could be made to cause an increase on the right for liabilities or equity, or it could cause a decrease on the left.
As we've said, accountants must analyze financial events that affect a business. Another more correct term for a financial event is a business transaction. There are two different types of business transactions: internal transactions and external transactions.
Internal transactions are financial events that take place within the business. These include adjusting entries and closing entries, all of which we will explain later. In internal transactions, outside parties are not involved.
External transactions are financial events that take place between an outside party and the business, such as sales, payment for office supplies, and the purchase of buildings. We'll now show you several financial transactions and the accounting for them. Accounting is all about learning mechanics and techniques. The technique we'll demonstrate is the accounting equation, that the left side of assets must equal the right side of liabilities and equity.
breaking news, the accounting equation of assets equal liabilities plus owner's equity always remains in balance. Does anybody have my itching powder?
Get the point here, people. The accounting equation must always balance.
Let's look at another business example.
Our business is called the Bathroom Network. It's owned by Stan.
Here at the Bathroom Network, we search the world over for the best in quality bathroom programming. You deserve access to your neighbors' private lives. You see, our network starts where the others stop. Join now and receive free of charge our Celebrity Bathroom Hour.
YMCA. Oh yeah, baby. Oh my God, girlfriend, let me tell you about this.
Put down those supermarket magazines and pick up the true story behind your favorite stars.
It's so hard to put on lip liner with these lights.
Watch us before we watch you.
Now let's use the opening of Stan's new company to demonstrate the effects of transactions on the accounting equation. Remember, you can always stop and rewind the tape if you need to. This example will show you some of the principles we have already discussed, and more importantly,
The double nature of accounting. Don't forget, every time an entry is made in one account, an entry will be made in another account that keeps the accounting equation in balance.
Stan starts his company by investing $13,300 of his personal cash into his business by opening up a company checking account.
Therefore, on our books, the company's cash account, an asset increases by $13,300, and his capital account, an owner's equity account, increases by $13,300.
Then he purchases $100 in supplies, like the drills and ladders he uses to insert his cameras into people's houses.
On our books, his cash account decreases by $100 because he paid out $100 in cash. But his supplies account, an asset, increases by $100 because he bought $100 worth of supplies. Thus, one asset account decreases while another increases on the same side of the equation, so the accounting equation still balances.
Disclaimer: the building account usually represents something that doesn't move.
Stan decides to buy a used truck with a satellite dish, which he can use as an office as well as a broadcast center. They cost $100,000. That's right, $100,000. Stan's a little new at this. For the sake of clarity, the truck and the satellite dish are represented by the building account.
The truck and satellite dish cost $100,000 with a $10,000 cash down payment, leaving his long-term mortgage at $90,000. So on our books, Stan's cash decreases by $10,000. His building account, an asset, increases by $100,000, and his mortgage payable account, a liability, increases by $90,000. So you add up all the asset account balances, then you add up all the liability and owner's equity account balances. You can see that assets equal liabilities plus owner's equity.
Stan then buys $5,000 in office equipment, such as cameras, wires, and satellite equipment to install his network. To do this, he pays $2,000 in cash, with the rest due by the end of the year.
Therefore, on our books, Stan's cash account decreases by another $2,000. His office equipment account, an asset, is increased by $5,000 because he has $5,000 in office equipment, and his accounts payable account, a liability, is increased by $3,000.
As you'll see, the accounting process begins with the general journal entries and then moves to the ledger.
With a manual accounting system like we're using, general journal entries are made daily, while posting to the ledger is done on a slightly less frequent basis. With a computerized accounting system, the process of posting to the ledger is either automatic or entered with a few keystrokes.
We divide the life of a business into accounting periods. It may be by a month, a quarter, or a year. At the end of each accounting period, we'll prepare financial statements that report on the health of the business.
In order to follow the realization and matching principles of GAAP, Revenues and expenses must be recognized in the accounting period in which they are earned or incurred, and not necessarily when cash changes hands. This system is known as the accrual basis of accounting. This method is opposed to the cash basis of accounting, which records revenues and expenses only when cash is received or paid.
The accrual basis revolves around the fact that businesses must account for expenses that have been incurred, even though the cash has not gone out for them yet. The cash basis of accounting can be used by simpler businesses and individuals like a child, or my brother Fred.
Peanut butter!
The accrual basis of accounting is more accurate and is a vital system for an accountant to learn. We'll go through an example of the accrual method to show you why it's more accurate than the cash method.
Stan performs services on credit for $500. In other words, his first group of subscribers charge their subscription on the credit account they have with Stan.
So on our books, because he has not yet received payment, accounts receivables, or money customers owe to Stan, is increased by $500. Also, Stan has earned $500 in revenue from the subscribers to his network. This revenue increases owner's equity, so the two sides still balance.
If the accountant had used the cash basis of accounting, he or she would have not recognized the revenue until the cash is received. Therefore, under the cash basis of accounting, revenue could have been understated. The reports generated after the first week would have been inaccurate, and you can't have inaccurate accounts or reports. That's why the accrual basis of accounting is so important.
Stan then decides to purchase another $500 in camera supplies on credit. He has a credit line with his supplier, so he puts the purchase on his account.
On our books, his supplies account, which you recall is an asset, increases by $500, and his accounts payable, a liability, also increases by $500 since he still owes the money. You can still see the double entry nature of accounting and how the sides balance out.
Being an honest and upstanding citizen, Stan prepays his utility expenses for the next 2 months, costing him $200.
So, on the books, his cash account, an asset, decreases by another $200, and his prepaid expenses account, another asset, increases by $200.
You can find this worksheet on your standard Deviants insert card.
Now, if you add all of the balances from the asset side, and you add all of the balances from the liability and equity side, you will see that assets equal liabilities plus equity. So, the accounting equation stands true. Assets must always equal liabilities plus owner's equity.
As you can see, it is very important that the accounting equation always remains in balance. If you're recording transactions and the equation does not balance, you know that you made a mistake.
Can't you see? Balanced accounting equations are good. Unbalanced ones are bad. Very, very bad. Sheesh!
Editor's note. The proprietor of the Bathroom Network, Stan, is a fictional character. Stan was created by this man, Alan Conant. Alan is a Capricorn who enjoys various activities like hiking and racquetball. For more information about Alan Conant, look somewhere else.
Part 2, double entry account. Yeah.
You've been doing double entry accounting for this video already. As we said, every time a transaction occurs, it's double the trouble for accountants. Whenever we record a transaction, at least 2 accounts are affected.
Section A, Accounts and the Ledger.
People keep accounts in many different forms, both in computers and on paper. Next, we'll talk about the way the information gets into the accounting system. All the accounts are entered and organized in what's called a ledger.
The ledger is the formal name for the books, or book of accounts.
Now let's talk about the way information gets into the accounting system, okay? You start. No. Okay, I'll start. Earlier we introduced the 5 major account types. Now let's talk about how they're used in the ledger. You guys are a real bright bunch, aren't you?
As we discussed earlier, most accounts may be classified into one of these 5 major account types. These account types are shown as T accounts because they look like capital T's. These are the super accounts we discussed earlier.
The T account is shaped like a T. It is used to determine a balance of a particular account. The T account has two sides. The left side of the T account is called the debit side, abbreviated DR, and the right side is called the credit side, abbreviated CR.
The account balance is the difference between total debits and total credits.
If the total of debits is larger than the total of credits, then the account is said to have a debit balance. If the total of credits exceeds the total of debits, then the account is said to have a credit balance.
People studying accounting often confuse the meaning of the words debit and credit. In accounting, debit means left and credit means right.
Debits and credits are simply accounting tools that are used to increase and decrease balances in accounts. The effect a debit or credit has on a particular account depends upon the type of account you are talking about. In other words, the effect a debit or credit has depends on which of the 5 account types you are dealing with.
I'm Super Accountant, and I will help you with your super accounts. I will go through each of the super accounts and tell you whether a debit is an increase or a decrease, and whether a credit is an increase or a decrease. The reasons for this will make more sense as we work through examples. Just remember, left means debit, right means credit.
Thank you, accounting man.
That's Super Accountant.
Super accountant.
It's okay, I'm not offended. I will use T accounts to illustrate how debits and credits work in accounting. It is vital to your safety as an accounting student to understand the following about how debits and credits work.
When you want to increase an asset account, debit it. If you want to decrease an asset account, credit it. This is shown on the screen as a plus or a minus.
It's exactly the opposite for liability and owner's equity T accounts. To increase a liability account or an owner's equity account, credit it. To decrease a liability or owner's equity account, debit it. This can again be seen with the plus and the minus on the screen representing an increase and decrease. Now I want to discuss the 2 remaining account types, revenues and expenses.
I think I can take it from here.
Then carry on, my little accounting buddy.
We said earlier that revenues increase owner's equity and expenses decrease owner's equity. This is true, but it is also important to understand how revenues and expenses themselves are affected by debits and credits.
Wait, somebody's in trouble. They're adding wrong.
Revenue accounts are increased by crediting them and decreased by debiting them because an increase in business revenue increases owner's equity.
Expense accounts are increased by debiting them and are decreased by crediting them because an increase in business expenses decreases owner's equity.
Now let's talk about how debits and credits are used to record transactions in the accounting system. Transactions are first recorded in the accounting system in what is called a general journal.
Section B, the General Journal.
As the day comes to a close and another gruesome battle has ended, I must tabulate the day's losses. 10,000 shells fired, 3,000 limbs severed, 500 desertions, and strangely, 23,000 cases of syphilis. What's even more strange is I only had 10,000 men. Maybe I should speak with my accountant.
What next, sir?
We must continue the accounting process. Give me your hand, soldier. Now get out of here.
Sir!
Dismiss!
An accountant records all transactions for the first time in one place. The reason for recording all transactions into one place first is that it offers an area to check for accuracy and reference every single transaction. Also, this is a quick and easy way to record several transactions at the same time.
These initial recordings are done in the General Journal, sometimes known as the Book of Original Entry or Book of Transactions, but never as the Book of Ultimate Evil. This is not an account, but rather the first place a transaction is recorded.
Notice for the General Journal that there is a date column, account titles, an account number column, and debit and credit columns. It's almost like your checking account register without the balance.
The posting reference, or account number column, holds the numeric reference assigned to an account when the transaction is posted. For basic accounting, the account number may not be very important, because often the account name is sufficient for referencing. But for businesses with hundreds of accounts, or those that use computers to keep their accounts, these numbers are useful. A listing of the accounts and their account numbers are illustrated in what is called a chart of accounts.
To record a transaction in the General Journal, place the date of the transaction in the first column. In the next column, the name of the account that is to be debited is written in the first line, and the account that is to be credited is placed on the second line and is indented. A brief written explanation of the transaction is shown below the listing of the accounts. The appropriate dollar amounts are entered in the debit and credit columns.
The rules for recording journal entries in accounting are very strict. Oh. Just like my father. God rest his soul. It was because I could never get his approval that I went into acting. So I could get the approval of others, of an audience. You were my love. Damn it, Dad! Where was the love?
Anyway, you always enter any accounts and dollar amounts to be debited before you enter your credits. In addition, every transaction will contain at least one debit and one credit. And one final rule: debits equal credits. This means that for any journal entry, the total dollar amount debited has to equal the total dollar amount credited.
To further explain general journal entries, we'll go back to the bathroom network.
Stan's initial investment transaction is recorded in the General Journal by first debiting cash for $13,300, because you record an increase in an asset account with a debit. Then, you credit the owner's capital account for $13,300, because an increase in an equity account is recorded with a credit. Finally, a brief explanation for the transaction is recorded in the General Journal.
In the buying of the truck, the building account is debited $100,000, since an increase in an asset is recorded as a debit, and the mortgage payable and cash accounts are credited for $90,000 and $10,000 respectively. Mortgage payable is credited because an increase in the liability accounts is recorded with a credit. Cash is credited because we are decreasing an asset account.
For the office equipment transaction, the office equipment account is debited $5,000 because an increase in an asset account is recorded with a debit, and the accounts payable is credited for $3,000 because we're increasing a liability. The cash account is credited $2,000 because it's an asset that's decreasing.
Purchasing supplies with cash debits the supplies account for $100 because an increase in an asset account is recorded as a debit. It credits the cash account for $100 because a decrease in the cash asset account is a credit.
So, who have you done accounting for in the past?
Well, I used to do some work on the scrolls for the Pharaoh of Egypt, and then I did a little bit of work for Amadeus before he got the gonorrheus. And since then, I've been back here in the States, and I did a little work for Johnny Rotten. Speaking of rotten, you smell something? Oh boy, that's a stinker!
Performing $500 of work on credit is entered as a debit to accounts receivable, an asset that is increasing, and as a credit to service revenue, a revenue account which is also increasing.
Buying $500 supplies on credit is entered as a debit to supplies and as a credit to accounts payable, a liability account.
And prepaying for expenses is entered as a debit to prepaid expenses and as a credit to cash.
Okay. Let's review what we just did.
Now the review. We recorded each of our transactions in the General Journal. The process is often called journalizing transactions. The journal is the first place transactions are entered into the accounting system, and every entry contained at least one debit and one credit. Debits were entered first, and credits followed. Our journal provides a list of every transaction the bathroom network conducted for a period. Whoa! Whoa!
Section C, the General Ledger. The next step in the accounting process is known as posting to the ledger. This involves taking the same information that's in the journal and transferring it to ledger accounts. Where the journal shows information by transaction in chronological order, the ledger shows the same information arranged by account type.
There are two formats for the ledger. Both formats can be used to represent the ledger. There's the T-account form used mostly in colleges, and there's the balance column format.
The balance column format is most often seen in businesses. The first column is for the date of the transaction. The second column explains the transaction. The third column records the posting reference number, and then there's a column for the debits, credits, and the balance of the account.
So the amount of the transaction, whether debit or credit, is placed in its appropriate column.
How do you know whether it's debit or credit?
Well, when we post to the ledger, we are simply transferring what was already done in the journal. If we debited an account in the journal, we will post it to the ledger as a debit. If we credited in the journal, then we credit it to the ledger.
Asset accounts are generally debit balances. Why? Because an increase in an asset account is recorded as a debit, and increases in assets are more common than decreases. If they weren't, everyone would be bankrupt. Liability accounts are usually credit balances, because increases in liabilities are credits for that account. The normal balance of an owner's equity account is a credit because an increase in an owner's equity account is a credit.
We'll use Stan's business as an example of posting to the ledger. First, transaction number 1, which is his original cash investment of $13,300. The two accounts on the ledger involved in this journal entry are cash and capital.
In the cash account in the ledger, the item in explanation is transferred from the journal. Then, the posting number, or account number, is placed in its column. The posting number for the ledger is simply the page number where the transaction appears in the general journal. This $13,300 transaction appears on page 1 of the journal. Then, the $13,300 debit is placed in the debit column, and the balance of the cash account after this transaction is a $13,300 debit balance, since it was zero before this.
The same is done for the owner's capital ledger account. The explanation is provided, then the posting reference is transferred. The $13,300 credit is placed in the credit column, and after this transaction, Stan's capital account has a credit balance of $13,300.
So that's it for posting the first transaction from the General Journal to the ledger. We came, we saw, we posted. Now let's post another entry to the ledger.
Remember that Stan bought his truck at a cost of $100,000 with a down payment of $10,000 and a mortgage of $90,000.
In the building account, we debit $100,000, resulting in a debit balance. Next, we must credit the mortgage payable account and the cash accounts for $90,000 and $10,000 respectively. At the end of this transaction, the mortgage payable account has a credit balance of $90,000 because it was zero and we increased it by $90,000. The cash account now has a debit balance of $3,300. Why? Because it was $13,300 after the initial investment, and we just decreased or credited it by $10,000, leaving a $3,300 balance.
We've now posted two transactions to the ledger. You might want to rewind this and try again. The rest of the transactions we journalized would be posted to the ledger in the same way. However, to save time on the tape, we won't go through all of them.
Section D, the trial balance.
The next step in the accounting process is to prepare a trial balance. A trial balance summarizes the ledger by listing all the accounts and their balances.
Storm.
Where's my lipstick? Has anybody seen my coffee bean lipstick? It's a new color that I got from Laura. Thank you. I knew you had it.
Let's go to our reporter who's at the 16th Annual Accountant Running Trials.
Well, the rain has finally cleared, and just in time for today's accountant running trials. Let's take a sneak peek at the championships as they warm up. It's interesting to watch all of the different tactics that they use, the stretching, the warming up.
A trial balance is a statement that shows the balances of all the accounts and calculates the total debits and total credits for the whole business.
Well, it looks like they're ready, so let's take a look at the action.
Gentlemen, on your mark. Sit.
The trial balance does not check the accuracy of the actual entries because an amount can be entered into a wrong account and still allow the trial balance to be equal. We're going to use the T account format to illustrate trial balance entries.
First step, balance each account by adding up the left and right sides of each T account. Second, you get the balance of the T for each account by subtracting the right side from the left side. If the left side is larger than the right side, you have a debit balance. If the right side is larger than the left side, you have a credit balance.
First, the balance of each T account must be calculated. So, add up the right and the left side of each T.
Looking again at the bathroom network, we will go through each of Stan's ledger accounts and prepare a trial balance. As you can see here, the cash balance is a $1,000 debit balance. The accounts receivable balance is a $500 debit balance. The supplies balance is a $600 debit balance. The prepaid expenses balance is a $200 debit balance. The office equipment balance is a $5,000 debit balance. And the building balance is a $100,000 debit balance.
Up to this point, all of Stan's accounts were debit balances because the debit side, or left side of the T, was larger than the right. Now let's check out some credit balances.
The accounts payable balance is a $3,500 credit balance. The mortgage payable balance is a $90,000 credit balance. The capital balance is a $13,300 credit balance. The service revenue balance is a $500 credit balance.
So you add up all of the balances to give you a trial balance for the company. For Stan, the following statement shows a total of $107,300 on each side, both debit and credit. If the total dollar amount debited doesn't equal the total dollar amount credited, we would know we messed it up.
Section E. Adjusting entries.
The accounting process does not always automatically provide us with the right balances. At the end of an accounting period, adjusting entries must be prepared before we prepare the financial statements. For example, situations arise in which an expense has been incurred but has not been recorded. This type of an adjustment is called an accrued expense.
It's important to note that when these adjusting entries are done, it's not because the accountant has done anything wrong, but rather the opposite. The accountant is merely reflecting the fact that an expense has been incurred.
Remember, these adjusting entries are made at the end of an accounting period. It applies the accrual basis of accounting to transactions that overlap between accounting periods. The accountant must make the adjusting entry or a business's financial statements will be inaccurately prepared.
Let's now look at some examples of adjusting entries. At this point, things have become a little confusing, so Stan has hired an accountant to help out. We'll say that Stan's accountant, Corduroy Cow, produces statements monthly.
I like your style, kid. Welcome aboard. You're my kind of employee.
Our first example of an adjusting entry is for supplies expense. Some of the business's assets may be used up over an accounting period. This decrease in an asset account must be recognized. Because the asset has been used, an expense has been incurred. Thus, the dollar amount used of the asset must be transferred to an expense account.
After the first month of his business, Stan has used $200 of his supplies, which he has already paid for. Stan now needs Corte Cal to account for the fact that part of his asset has been used. An adjusting entry must be made to recognize it in this accounting period.
In his general journal, Corte Cal debits the business's supplies expense account for $200 and credits supplies for $200. This increases the supplies expense account and decreases the supplies asset account, sometimes called supplies on hand. This represents a decrease in the supplies, or the drills and ladders. Next, on to depreciation.
Now, when car salesmen talk about depreciation, they're talking about the decrease in the market value of an asset. But when accountants talk about depreciation, they're talking about allocating the costs of the asset to an expense account in the periods benefited by the asset's use.
Huh? In other words, while the asset is being used to generate revenues, the accountant has to allocate an expense for that asset. This represents the amount of cost used in generating those revenues.
The cost is recorded in an account called depreciation expense. Depreciation expense represents the amount of the asset's cost that we want to expense in a given year. There are many ways to calculate depreciation, and some of them are complex, so we'll save it for another tape.
The effects of depreciation are shown on the balance sheet through a separate account called accumulated depreciation. This is also an asset account, but it is different in that it's a contra asset.
We will explain this in detail later, but for now, you need to know that contra assets are the only type of asset that gets credited when they increase, because their purpose is to decrease the book value of an asset.
Here's Sunny Day with an editorial. Sunny?
So, to reiterate, a contra asset is different than a normal asset in that it gets credited when it increases. This is different from normal assets, where an increase is a debit.
Over the month, Stan's truck and equipment have depreciated in their usefulness. His truck has depreciated by $100 and his office equipment by $500. Corte Cal must therefore make the adjusting entries for depreciation of the truck, satellite dish, and equipment.
Separate accounts are kept for the depreciation of each item in order to more closely identify and describe depreciation within the business. This allows you to know how much depreciation you have for each asset.
The truck's depreciation expense is debited $100 to represent the increase, and accumulated depreciation, a contra asset, is credited $100. Notice how you credit rather than debit a contra asset for an increase.
The office equipment's depreciation expense is debited $500, and its accumulated depreciation is credited $500.
Our next example of an adjustment covers prepaid expenses. The business may have prepaid an expense for several accounting periods, but at the end of each period, it must recognize the fact that part of the asset has been used and an expense has been incurred. So adjusting entries must be made for these prepaid expenses, such as Stan's utility bill. If the adjustment isn't made, Stan's financial statements will be off.
If you remember, Stan prepaid $200 of his utilities expense for 2 months. In the normal course of business, at the end of 1 month, he has used $100 in utilities expenses, but still has $100 of credit left.
So, I have to make an adjusting entry to account for this. The utilities expense account is debited for $100, and prepaid expenses are credited for $100, lowering the prepaid expense account by $100 since he has now used $100 of utilities that month.
Accrued revenue is another example of an adjustment. Often a business agrees to perform services that span several accounting periods, with payment due at the completion of service. At the end of each accounting period, the accountant must recognize that revenue has been earned for that period, even though the cash has not been received.
So, the business is now owed that money and must recognize the increases in the accounts receivable account and in the revenue account. So, if the business does work for a customer but doesn't get paid, right away that creates accounts receivable.
On January 1st, Stan entered into a contract with Jimmy O'Malley to provide his bar with bathroom network programming for 3 months.
When Stan provides Jimmy with programming for 3 months for his bar, he'll pay him $900. At the end of 1 month, Stan has completed a third of the work, so he's earned $300. Jimmy effectively owes Stan $300 for work already performed. However, Stan isn't going to receive Jimmy's cash for another 2 months.
The accountant must make an adjusting entry that increases both his accounts receivable and revenue account to account for the fact that Stan has earned revenue.
His journal entry debits accounts receivable and asset account for $300 because he has performed 1 month worth of network coverage, and although he hasn't gotten the cash for it, he is owed it. Corduroy Cal also credits revenue for $300 since he has now earned $300 worth of revenue.
The last type of adjustment we'll cover is called unearned revenue. Sometimes the business is prepaid by customers or clients for services to be provided in the future. This is known as unearned revenue and is considered a performance liability.
I would like to welcome to the team the #1 draft pick, Frank Johnson! Frank has also just signed a $10 million 8-year contract!
Unearned revenue is like Frank's contract. He hasn't performed yet. So when the business, or in this instance Frank, is paid early by a client for work not yet performed, the money goes into unearned revenue.
Get up, Frank! You haven't performed yet! Get on your feet, come on! No pain, no gain! Get up, you little sissy! Oh!
After a portion of the work is done in an accounting period, that portion is transferred from unearned revenue to earned or regular revenue. The purpose of this adjustment is to record the amount of revenue that has been earned as of the end of the period.
We're getting closer to our goal of preparing financial statements, but in order to get there, you must know how to take the trial balance, which we've already covered, and make adjustments to it.
The trial balance, to reiterate, is a statement that shows the balances of all the accounts. It calculates the total debits and total credits for the whole business, which by virtue of our previous accounting work, we know equal one another. We must now update our trial balance to reflect our adjusting entries. In order to easily illustrate how to make the adjustments, we will use a worksheet. A worksheet is a useful tool for accountants to show the effects of the adjustments on the trial balance.
Okay, class, let's take out our worksheets. Today, we're going to show the effects of the adjustments on the trial balance.
Let's look at Stan's worksheet. You can see Stan's original accounts and their balances. You should remember these from the first time we did a trial balance way back in the T account section. Now you see them here. So, this, once again, is Stan's trial balance.
Here are some new accounts that need adjustments. Depreciation expense and accumulated depreciation for the truck. Depreciation expense and accumulated depreciation for the cameras. Supplies expense for his use of supplies which were already paid for. And the utilities expense for the prepaid utilities.
We did not have these accounts listed when we did Stan's original trial balance because we had not come to the adjustments section yet. So in order to make it to the financial statements, we must update Stan's original trial balance to reflect the adjustments.
First, we will make the adjustments to the already existing accounts which appeared on the original trial balance. You can see them here.
Accounts receivable, an asset account, is debited $300 to represent the money Stan earned for Jimmy's first month of his 3-month subscription. The supplies account is credited $200 because Stan used these supplies. Prepaid expenses is credited $100 because Stan used up $100 of his prepaid utilities bill. And revenue is credited $300 because Stan earned $300 from the subscription, even though he didn't receive it yet.
Here's Dr. Naylor with Health Watch. Doc?
Oh! Well, it's that time of year again. Remember to adjust your trial balance. If new accounts enter your system and aren't reconciled with the old ones, then your whole system could be off. Now, your local pharmacist should have the necessary worksheet to combine those pesky intruders with your current debits and credits. I think I found your problem.
Thanks, Doc. We'll all be sure to get right on that. And somebody should get on you, you freak.
I'll be in for my appointment later, Doc.
Now we'll make the needed adjustments to the new accounts which were listed earlier. First, we debit depreciation expense, an owner's equity account, by $100 for the depreciation of the truck. Then we credit accumulated depreciation for the truck by $100. Why credit this asset account if you are increasing it? Because, as we explained, it's a contra asset. Contra assets are increased by credits.
Next, we move to the office equipment. The depreciation expense for the office equipment is a debit of $500, and accumulated depreciation for the office equipment is a $500 credit since it's a contra asset. Next, supplies expense is a $200 debit because it represents Stan's use of $200 in supplies. Finally, utilities expense is a $100 debit because Stan used $100 worth of utilities, so he's incurred $100 in expenses, and thus a debit is made.
Now the adjusted balances of each account must be tabulated. This just means moving from right to left across the worksheet.
All you need to do is merge the two columns, the trial balance and the adjustments. You need to either add the debits together for each account, add the credits together for each account, or, if there is a debit and a credit, subtract the smaller of the two from the larger. So if you have two debits, like we do in accounts receivable, you add them together. $500 plus $300 equals $800. If you have two credits, like we do in the revenue account, you add them together. $500 plus $300 equals $800. If you have a debit and a credit, like we do in the supplies account, you subtract the smaller from the larger. So, the $200 credit is subtracted from the $600 debit to get a $400 debit.
After appropriately adding or subtracting the adjustments, the adjusted balances of the first set of accounts is represented in this column, the adjusted trial balance column. Each account has either a debit balance or credit balance, so cash has a debit balance of $1,000. Accounts receivable has a debit balance of $800. Supplies has a debit balance of $400. Prepaid expenses has a debit balance of $100. Office equipment has a debit balance of $5,000. Building has a debit balance of $100,000. Accounts payable has a credit balance of $3,500. Mortgage has a credit balance of $90,000. Revenue has a credit balance of $800. And capital has a credit balance of $13,300.
Don't stress. We're getting closer to finishing the adjusted trial balance. Now we need to do the same adding and subtracting for the new accounts here to determine the balance of each new account. However, you don't need to merge the new accounts with any old numbers because they're new. You just carry them over to the trial balance column.
Here we've got the final adjusted trial balance column. If you add up both sides, the debits and the credits, you can see that they equal, which means Stan's entries were correct.
Now we have an adjusted trial balance from which we can compile the official financial statements. Did I tell you, Jethro, there'll be no paycheck for you this year?
Equity!
Equity!
Equity! Equity!
Equity. Cologne for accountants. At all fine stores now.
Section F. Income statement.
Now let's go back to Stan and his worksheet. As you know, we have reached the point of the adjusted trial balance. So, the good news is, with these numbers, we can do the income statement, the statement of owner's capital, and the balance sheet.
Let's go to our on-the-spot reporter, Steele Shanahan, for this special report. Steele?
Thanks, Storm. I've just learned that in doing the financial statements, it is important to note that first you must complete the income statement, then the statement of owner's capital, and then the balance sheet.
Steele, have you learned why this happens?
Yes, it appears as though you need numbers from the former to complete the latter.
Oh, more on this as it develops.
Are those for me?
No.
First, the income statement. Basically, the income statement is revenues minus expenses equals net income. This is what Stan's income statement looks like. We'll now go through each part of the worksheet. Remember, for each section of the financial statements, you must get the amount from the adjusted trial balance columns. So, Stan's revenue is equal to $800. Next, his expenses. These are his expenses. The depreciation expense for the truck is $100, a depreciation expense for equipment of $500, a supplies expense of $200, and a utilities expense of $100.
So, Stan's total revenue is $800, while his total expenses are $900. Therefore, his net loss for the first month of his business is $100, or revenue minus expenses.
Now for Stan's statement of changes in owner's equity. This statement tallies the capital or owner's equity in the business.
Once again, this statement equals beginning capital plus investments by the owner minus net loss minus withdrawals by the owner. This equals the change in owner's capital. To do this statement, you obviously need to complete the income statement first.
Since this is Stan's first month of business, his beginning capital is $0. To this we add the $13,300 he invested in his business.
We also subtract the $100 in net loss we calculated from the income statement. Stan has not withdrawn any money from the business for personal use, so there's nothing to deduct on this statement. Thus, the ending owner's equity, or capital, is $13,200.
That's it for Stan's statement of changes in owner's capital. Now, the classified balance sheet.
Section G, classified balance sheet.
Earlier in the video, we showed you what a regular balance sheet looks like. Now we move to the classified balance sheet. The classified balance sheet breaks up the assets and liabilities account classifications to more adequately describe those classifications.
On a classified balance sheet, two of the major account classifications are broken into several areas so that you can analyze the state of the business with a glance. Several accounts with similar characteristics are listed under the same classification for better reference.
Well, what do we have here? Single female accountant, full-figured dominatrix, sexy mama, seeks corduroy guy for submissive love pouncing. That's me.
On a classified balance sheet, assets are divided into 4 distinguishable areas. 1. Current assets. 2. Investments. 3. Plant and equipment. And 4. Intangible assets.
Current assets are those assets that can be sold for cash or will be consumed within a year. Some examples are cash, short-term investments, accounts receivable, and prepaid expenses.
Investments include stocks, bonds, and promissory notes of other companies that you anticipate holding for more than 1 year. It can also include land that is being held for future expansion, but is not used in the operation of the business.
Plant and equipment represent tangible long-life assets that are used directly in the operation of the business. These include store equipment, buildings, office equipment, and land being directly used in operation of the business.
Alright, I'll put the thing on the thing.
I think we're supposed to fix that thing now, the rusty thing down there.
I like the blue.
I think we're supposed to work on
fix
we're
the blue.
supposed to
What's rust?
the
Don't
rusty
hit me.
one.
I don't understand.
The rusty
I
one.
don't like
The ru-
violence. I don't like violence. Stop it. Oh, that's nice.
Okay, all intangible assets are non-physical resources that benefit the business financially. For example, patents, copyrights, and licenses.
Classified balance sheets also reflect contra accounts. We briefly discussed contra accounts when we spoke of depreciation. The contra account is used to deduct an amount from another account so that a more accurate value of that account can be portrayed. For example, accumulated depreciation is a contra asset account because, in order to find the book value of the corresponding asset, we must subtract the amount depreciated from the original cost of the asset. Accumulated depreciation is a contra asset account in which we add all depreciation for a particular asset, like Stan's truck, and subtract it from the truck's cost to determine its book value.
Contra assets are treated opposite of other assets, so feel free to insult them whenever you feel like it. Stupid contra asset. Oh. When you increase a contra asset, you credit the account instead of debiting it. Just remember that you treat a contra asset opposite of a normal asset. That's it for assets on classified balance sheet. Now on to liabilities.
The liabilities on the classified balance sheet are divided into two major areas: current liabilities and long-term liabilities.
Current liabilities are those that will be paid off or liquidated within 1 year. For example, accounts payable and salaries payable are both current liabilities. Your bills and salaries should all be paid within a year. I mean, unless you're some kind of yahoo.
Long-term liabilities are those which have payment due in more than a year. For example, a mortgage is a long-term liability, which you'll have to pay for a long time.
What would you say is your greatest liability?
Well, aside from the gas, which is quite a problem, sometimes I forget to shake and I get little spots on my pants. I also use a little bit too much toilet paper and it tends to clog the toilet, but I just won this award, which I think makes up for everything because it shows that I'm really talented, you know what I'm saying?
Stan's classified balance sheet has current assets, plant and equipment, as well as current and long-term liabilities, but no investments or intangible assets.
We must look on the worksheet to obtain the balances for each of the asset and liability areas on the classified balance sheet. First, current assets, or short-term assets. Then, investments, such as stocks and bonds that the company owns. These are different from the owner's personal investment in the company. Then, plant and equipment, stuff used in his business. And finally, intangible assets, or items like copyrights.
This is what the Assets section of Stan's classified balance sheet looks like. We got these numbers from the adjusted trial balance column on the worksheet. His current assets are cash, $1,000, accounts receivable, $800, supplies, $400, and prepaid expenses, $100. If you add all of the current assets up, his total current assets are $2,300.
Stan's bathroom network owns no stocks or bonds, so you put nothing in for investments. Stan's plant and equipment assets are office equipment, $5,000, and building, $100,000.
But as we've learned, for the classified balance sheet, you must take into account depreciation, a contra asset.
The contra asset account, accumulated depreciation, is $500 for the office equipment, There is $100 in accumulated depreciation for the building or truck. Both of these are listed on the worksheet and must be deducted from these asset accounts.
So, when you add the office equipment minus its depreciation and add the building minus its depreciation, you've got a total plant and equipment with a book value of $104,400. Stan has no intangible assets.
So, the final step of the assets section is to add his current assets and his plant and equipment assets to get $106,700.
Now on to liabilities.
This is what the section on liabilities looks like. Like other sections, it has a lot of numbers, but unlike other sections, this one is about liabilities. On the worksheet, Stan has both current and long-term liabilities. His current liabilities are accounts payable, which is $3,500. Therefore, his total current liabilities are $3,500.
So this goes on the classified balance sheet. Now Stan's long-term liabilities are equal to his mortgage of $90,000.
On the classified balance sheet, you add both current and long-term liabilities for a total liabilities amount of $93,500.
The final step of the classified balance sheet is to take the total owner's equity amount from Stan's statement of owner's equity. This amount is $13,200.
As you can see on the final classified balance sheet, Stan's total assets were equal to $106,700. His total liabilities plus owner's equity also equals $106,700. So, once again, assets equal the liabilities plus the owner's equity. And they lived happily ever after.
Okay, the last thing I need is a writing sample.
Well, you might heard of one thing I wrote a while back. It was called the Emancipation Proclamation. And also I did a little thing called the Dead Sea Scrolls. Oh, and speaking of dead, I think something died in my pants. Woo!
Section H, Closing Entries.
We're now close to the final step in the accounting process. An accountant's work is based on periods of time. Income statements and statements showing the changes in owner's equity are prepared to reflect transactions over a period of time.
In order for those statements to accurately reflect a specific period of time, the accountant must restart the revenue and expense accounts to zero, because these are the accounts upon which the statements are based.
In a way, these are like temporary or nominal accounts because they must periodically be set to zero. This is unlike asset, liability, and capital accounts, which remain open and are known as permanent or real accounts. Permanent accounts are not reset like temporary accounts.
When accountants set these accounts to zero, they can't just erase the books and start over. Instead, they must transfer the information from those accounts to a different spot on the books.
Accountants do this by making what are called closing entries in the journal. When you close an account, that means you're making its balance zero. In closing entries, the accountant transfers the amounts in the revenue and expense accounts to a new account called income summary. Yeah, income summary. Now get in there. Get in there. Come on. It's warm. Come on, go. You'll like it. Now stay put.
After the closing entries have been properly prepared, the revenue and expense accounts will have zero balances. The income summary is a separate temporary area on the books.
Closing out these accounts not only starts the revenue and expense accounts on the books at zero, but also shows the effects of the increases and decreases from the revenue and expense accounts on the total owner's equity. These accounts then maintain a table of the owner's equity changes for that period, since after every new period, they're reset.
Closing out these accounts shows how much the business, and thus the owners, made over the time period. Starting these accounts at zero is also necessary to begin a new accounting period. Don't worry, my fine accounting friends, we'll show you how to do this. First revenue accounts and then expense accounts.
Remember that revenue accounts are owner's equity, so a debit is a decrease and a credit is an increase. Revenue accounts have a credit balance. In order to close the revenue accounts, the accountant must debit them for their full balance and credit the total amount to income summary.
For Stan, this entry is a debit or a decrease in service revenue for $800 and a credit or increase to the income summary for $800. This leaves his service revenue account with a zero balance and the income summary account with an $800 credit.
Now on to expense accounts.
Expense accounts have a debit balance. Remember that expenses are increased by debits and decreased by credits. So, to close them out to zero, the accountant must credit each expense account for its full amount and debit it to income summary for the same amount.
Revenue accounts are set to zero.
By debiting them.
Expense accounts are set to zero.
By crediting them.
Revenue.
Expense.
Revenue.
Expense.
Revenue accounts are set to zero by...
Shut up, we're done already. Cut!
Stan's accountant makes the following entries. He debits the income summary account for the $100 in depreciation expenses for the truck and credits this expense account for $100. The income summary is debited $500 in depreciation expenses for the office equipment, and the depreciation expense account is credited for $500. The accountant also debits the income summary for $200 in supplies expenses and credits the supplies expense account for $200. Finally, he debits the income summary for the $100 in utilities expenses and credits this expense account for $100. This leaves all the expense accounts with a zero balance, and adding all the total expenses for the income summary equals $900.
Now that this income summary is created, all of the revenue and expense accounts on the books should be zero. As you can see from our income summary here, after debiting for all the expenses, the income summary debit side totals $900. The credit side totals $800. When the smaller number is subtracted from the larger, we get a debit balance on the income summary of $100.
Now that you've closed the revenue accounts and the expense accounts to the income summary account must also be closed. The income summary account is now a representation of the amount the business lost during the accounting period. Income summary is an account that's used only during the closing process.
It's almost like a purgatory. It is merely a spot that the accountant can put the numbers from the revenues and expense accounts during the closing process. The owners can also see what the business's net income is for that period by looking at the income summary account. But the reason it's a purgatory is that this financial information doesn't stay there. The income summary account summarizes the revenue and expense information, but it is also closed out.
This information from the income summary now represents the business's loss for the period. So I can take this total and subtract it from the owner's capital account, or owner's equity account, to represent the decrease in Stan's capital.
So Cal credits income summary for its debit balance of $100 and debit capital for $100. This closes the income summary. Remember, to close an account means to make its balance be zero.
And now let's go back out to the accountant running trials to Steele Shanahan, who is at the finish line.
So, what did it take out there today?
Well, we knew our accounting well, and we had the terminology down pat.
Yeah, it seemed at times, especially during the income statement part, that we weren't going to make it, but, you know, we're accountants. That's what we trained for.
Well, there you have it. One accountant, one unquenchable thirst to be the first through the accounting process. What a day. I'm Steele Shanahan, reporting live from the accountant running trials.
Thank you, Steele. Do I have time to go to the bathroom?
No. No, you cannot go.
I have to go.
Hold it.
The last step in the accounting process is to prepare a post-closing trial balance. To do this, you must list all of your accounts that have not been closed out and also their balances, and then add up those balances. This is the final balance of all your permanent accounts. The only accounts left with a balance after the closing entries have been made are the permanent accounts: asset, liability, and owner's equity accounts.
We don't need to walk you through the post-closing trial balance, since you've already done the hard part. Let's reminisce.
You have made your closing entries. You've brought the revenues and expenses to zero. In doing so, you transferred the balance in those accounts to the income summary account. You've used the income summary account to determine the amount of net loss the business incurred during that period. And you have taken that amount and subtracted it from the capital account by debiting that amount to capital.
The only accounts left for this final step are assets, liabilities, and owner's capital. Why? Because all the temporary accounts have been closed or set to zero.
So here on Stan's post-closing trial balance, you see all the accounts listed that still have a balance. They either have a credit or debit balance. But notice when you add them all up, debits still equal credits. We've come through the accounting process with our accounts balanced.
We've covered many different subjects, like the account, assets, liabilities and equity, T accounts, balance column accounts, double entry accounting, accrual accounting, adjustments, the classified balance sheet, the income statement, owner's equity, closing the accounts, and the trial balance.
Be sure to look for the eye-popping world of accounting part 2.
So if you have any questions about anything at all, just give us a call here at Cerebellum at 1-800-VCR-REVIEW. We'd love to hear from you. But for now, bye-bye.
Bye! Hey, thanks for watching, you guys. Study hard.
Appropriate column.
Oh, thank you. Good?
Yeah,
Oh,
looks great.
Let me fix yours. Okay, there you go, Mom.
At a concrete point in time. And bang.
The revenue account totals the increase in a business's assets.
So I'm going into the bank and there's this hot-looking pink furry puppet in there. Woo, baby! And I walk up to her and I said, "Hey, want to see my assets?"
Oh, bank assets! Oh!
Good evening. I'm not done yet.